Hello, it's Oscar, a lead analyst at Binarium. In today's video, I'll break down the Fibonacci retracement trading strategy and demonstrate one of the ways to trade profitably using it. But before we dive into the strategy, let's refresh what the Fibonacci sequence is all about. It's an infinite series of natural numbers where each number is the sum of the two preceding ones. Every number in the sequence is approximately 1.618 times larger than the one before it. The golden ratio of 1.618 forms the foundation for Fibonacci retracement levels. When dividing the numbers in the sequence in a specific order, we get the key percentages: 23.6%, 38.2%, 61.8%, and 161.8%. The golden ratio splits the price chart into sections based on 38.2% and 61.8%. These percentages are used in technical analysis to evaluate the market and predict potential price reversals. Fibonacci levels help identify points where the price may pivot in the opposite direction. Now let's get into the Fibonacci lines trading strategy. The first thing to remember is that this strategy works best in a trending market. For instance, let's look at the chart for the Australian and New Zealand dollar pair. You can clearly see the formation of local highs and lows. When a new growth phase begins, fresh highs and lows appear, which become the basis for identifying Fibonacci retracement entry points. Next, you need to identify retracements on the chart. To do this, select the Fibonacci lines tool. You'll find it in the bottom left corner of the terminal under Graphic Tools. The concept behind Fibonacci lines is simple. Focus on buying when the retracement reaches the golden ratio levels of 38.2% and 50%, and on selling when it hits the 61.8% level. It's worth noting that the golden ratio often acts as support during market uptrends, while the 61.8% level serves as resistance during downtrends. How does this look on the chart? Let me show you how to apply Fibonacci levels along with moving averages using a practical example. The first step is to configure your chart. In the terminal's bottom left corner, select the Simple Moving Average (SMA) indicator and set the period to 12. This makes it easier to spot entry points. Now, you can clearly see on the chart that after forming a high, the price curve reverses into a downtrend. However, this correction doesn't fully negate the previous upward movement. What other insights can we gain from this chart? The price curve broke through the 38.2% and 50% Fibonacci levels before stopping at the 61.8% level. This level usually serves as the endpoint of downward retracements within a bullish market. This is a signal that the price may reverse upward. Additionally, the moving averages, positioned above the price graph, acted as another signal supporting the downtrend, making selling the priority. You can also see a double confirmation for a potential upward trend. First, the asset rebounded from the 61.8% Fibonacci level, indicating growth. Second, it crossed the indicator line on the chart. Now, let's use a real example to pinpoint an entry point and make a forecast. I'll apply the Fibonacci retracement tool, stretching it from a local low to a high. The 61.8% Fibonacci level suggests a price stall and potential reversal. There's a high probability that the price will move upward. So, I place a trade for growth by clicking the green button with the upward arrow in the terminal's bottom right corner. This is a forecast for growth. The prediction has been made. For a while, you can observe how the price attempts to stabilize at the support level. At this point, market participants aren't keen on selling this asset, and there's no intention of reversing the previous upward movement. There might be some false breakouts, but that's normal. Eventually, the price moves upward as predicted. The trade closed in profit, and I received a notification confirming the gains. Fibonacci lines are one of the most effective trading strategies out there. Apply them in your practice, make accurate forecasts, and start earning with Binarium.